If you enjoyed this audiobook, please consider liking, sharing, and subscribing to the channel. Chapter 1: The Codebreaker Before the Code. Part 1: A Mind Built for Pattern, Not Finance. Most people assume Wall Street legends are built in trading pits, not university libraries. Jim Simons breaks that assumption completely. Simons earned his PhD in mathematics from the University of California, Berkeley, at just 23 years old. While his peers were reading stock charts, he was studying differential geometry, a field concerned with measuring curvature and structure in spaces that human beings cannot even visualize. It sounds completely disconnected from money. That is precisely what made it so powerful. Think of differential geometry this way. Imagine you are an ant walking across a crumpled piece of paper. From your position on the surface, the paper looks flat. But if you could measure how your path curves over time, you would eventually detect the hidden shape beneath you. Simons spent years training his mind to do exactly this, to find hidden structure that is invisible at first glance. That habit of thinking would later become the engine of the greatest trading operation in financial history. What separates Simons from every successful investor who came before him is not intelligence alone. Warren Buffett reads companies. George Soros reads economies. Simons was wired differently. He read data the way a musician reads silence, looking for what was hiding between the obvious notes. Gregory Zuckerman, who spent years researching Simons for his book, makes this point clearly. The mathematical training was not background noise. It was the whole story. Markets are full of noise. Prices move, traders panic, headlines scream. Most people respond to that noise. Simons was trained, at the deepest level of his professional formation, to filter it out and find what actually repeated underneath. His geometric frameworks gave him a mental template for detecting patterns that conventional financial analysis could not see and human intuition would never trust. That is the quiet origin of an extraordinary machine. Not ambition, not greed, but a mathematician's stubborn instinct to find the signal hiding inside chaos. Part 2: Code Breaking for the NSA and Getting Fired for It. That same pattern-hunting instinct did not stay locked inside university lecture halls. Before Simons ever thought seriously about markets, he was handed a far more urgent puzzle, one with genuine national security stakes. In the 1960s, Simons worked at the Institute for Defense Analyses, a secretive think tank that provided analytical support to the National Security Agency. His job, in simple terms, was to stare at streams of Soviet communications that looked completely random and find structure hiding inside them. Think of it like receiving thousands of pages of scrambled text and being asked to find a repeating rhythm buried somewhere in the noise. That is exactly the kind of problem a differential geometer is built for. Simons was not guessing. He was applying rigorous mathematical methods to detect statistical regularities that no ordinary analyst would even know to look for. The connection between this work and what he later built at Renaissance Technologies is almost uncomfortably direct. Markets, like encrypted Soviet communications, generate enormous amounts of data that appears random on the surface. Most people accept that appearance at face value. Simons had already spent years professionally refusing to do exactly that. But this chapter of his life reveals something more important than a useful skill. It reveals character. In 1968, at the height of the Vietnam War, Simons wrote a public letter to a newspaper opposing the conflict. The IDA had an explicit rule: staff did not make public political statements. Simons knew the rule and wrote the letter anyway. He was fired. That decision tells you everything. Here was a man with a prestigious, well-paying position inside one of the most elite analytical organizations in the United States. And he walked away from it rather than stay quiet about something he believed. He was not reckless. He was simply incapable of pretending to agree with something he did not. That quality, the refusal to perform institutional loyalty at the cost of honest thinking, became the defining cultural feature of Renaissance Technologies decades later. The firm would eventually operate in ways that broke every convention of the financial industry. And it would do so deliberately and without apology. That attitude started here, in a decision to send a letter that everyone around him would have advised against sending. Part 3. Building mathematical reputation before Wall Street fame. That refusal to stay silent, the same instinct that ended his government career, turns out to be only half the story of what made Simons dangerous. The other half was built quietly inside a university campus on Long Island, far from any trading floor or government facility. When Simons became chairman of the mathematics department at Stony Brook University in 1968, most people around him saw a brilliant mathematician settling into academic life. What Simons was actually doing was learning how to build something. He did not inherit a prestigious department. Stony Brook was young and relatively unknown. What he did with it is genuinely remarkable. He went out and recruited some of the best mathematical minds in the world, often pulling people away from far more established institutions. He had a gift for spotting talent that others had overlooked, and more importantly, he had a gift for making exceptional people want to be in the room with him. Within a few years, Stony Brook's mathematics department had a reputation that extended well beyond American academia. During this period, Simons collaborated with the Chinese-American mathematician Xing-Shen Chern to develop what became known as the Chern-Simons form. If that name means nothing to you, here is what matters. It is a piece of mathematics so fundamental that theoretical physicists still use it today in string theory and quantum field theory, areas of science that did not even fully exist when Simons first wrote it down. He was not solving problems that were in front of him. He was building tools that would matter to people working on questions nobody had asked yet. But the real lesson from Stony Brook was not the mathematics. It was the management. Simons learned something here that money alone cannot buy: how to gather brilliant, stubborn, unconventional people, point them at an interesting problem, and keep them genuinely motivated. These are not easy people to lead. They are not impressed by titles or seniority. They stay engaged only if the work itself is worth their time. Simons figured out how to make it worth their time. That skill, call it talent architecture, would become the actual engine of Renaissance technologies. The algorithms mattered, yes, but the reason the algorithms kept improving year after year was that Simons kept filling the building with people who were constitutionally unable to leave a problem half-solved. He knew how to find them, and he knew how to keep them. He had been practicing for decades before Wall Street ever heard his name. Part 4. Monemetrics, the messy human beginning. What if the smartest person in the room is also the worst trader in the room? That was Jim Simons in 1978. When Simons launched Monemetrics from a strip mall office in Setauket, Long Island, he brought with him a Fields Medal-adjacent reputation, a codebreaker's instincts, and almost no practical experience in financial markets. The fund's name was a blend of money and econometrics, which sounded precise and scientific. The reality was far messier. Simons and his early partners, including Leonard Baum, the mathematician behind the Baum-Welch algorithm, were making trading decisions the same way everyone else on Wall Street was: reading the news, following gut feelings, and arguing about what currencies and commodities might do next. And they lost. A lot. Monemetrics suffered drawdowns that would make most investors walk away permanently. Positions went wrong. Partners clashed. There were stretches where the fund teetered on the edge of collapse, and the interpersonal friction between strong-willed, brilliant people made everything worse. Simons himself would sometimes override the models they were building with his own instincts, and those instincts, more often than not, cost money. This is the part of the Simons story that most profiles skip over, because it is uncomfortable. A genius making very human, very expensive mistakes. What Zuckerman captures so well is that this chaos was not wasted time. Every failure was pushing Simons toward a conclusion he deeply resisted. Human judgment was the problem, not the solution. The models he and Baum were developing kept working until a person interfered. The pattern was impossible to ignore. This is a genuinely hard thing to accept about yourself, especially if you are someone who has spent a career being the smartest person in every room. Simons had to watch his own instincts fail repeatedly before he was willing to let go of them entirely. That ego-shattering process, not the algorithms themselves, was the real turning point. Renaissance Technologies was not built on a breakthrough. Chapter 2: Building the Black Box. Part 1: The Radical Staffing Decision That Changed Finance. Most people assume Wall Street's best investors are people who grew up obsessed with markets. Jim Simons proved that assumption wrong in the most dramatic way possible. When Simons was building Renaissance Technologies, he made a hiring decision that seemed almost offensive to the finance world. He refused to hire anyone from it. No MBA graduates, no former traders, no economists who had spent careers theorizing about market behavior. If you had spent years learning how financial markets were supposed to work, Simons wasn't interested in you. In fact, that experience was closer to a disqualifier than a credential. What he wanted instead were people who had never learned what markets couldn't do. He recruited Elwyn Berlekamp, a coding theorist who had spent his career at Bell Labs working on information theory, not stocks. He brought in Henry Laufer, a mathematician whose background was in pure mathematical modeling. Later, he hired Robert Mercer and Peter Brown directly from IBM, where they had been building speech recognition software. These men had never managed a portfolio in their lives. That was precisely the point. Think of it this way: if you teach a child that the stove is always cold, they'll never check. Financial professionals had been taught so many rules about market behavior, rules passed down through decades of Wall Street culture, that they carried invisible limits in their heads. Simons wanted people who had no such limits, people who would look at raw price data the same way a physicist looks at a new particle, with curiosity, not assumption. Gregory Zuckerman, who documented Renaissance's rise in meticulous detail, makes the case that this wasn't just a quirky preference. It was the founding logic of the entire enterprise. When you have no inherited beliefs about what a market should do, you are genuinely free to discover what it actually does. That distinction between should and does turned out to be worth billions. The result was a team that approached financial data the way scientists approach experimental results. Without ego, without tradition, and without the career incentive to confirm what they already believed. That intellectual freedom, combined with serious mathematical firepower, became the foundation on which everything else at Renaissance was built. Part 2: Hoarding History: How Renaissance Built Its Information Moat. That intellectual freedom meant nothing, however, without the raw material to work with. And in quantitative finance, raw material means data, lots of it, going back as far as possible. Simons and his team understood something that most of their competitors missed entirely. A mathematical model is only as good as the history it learns from. If you feed a system 10 years of prices, it can find patterns in 10 years of market behavior. Feed it 50 years, and suddenly it can recognize patterns that only appear during rare conditions. Currency crises, interest rate shocks, commodity squeezes, the kinds of events that happen once a generation but repeat in statistically recognizable ways when you know what to look for. So, Renaissance went hunting for old data everywhere. They pulled price records from commodity exchange archives. They tracked down defunct regional newspapers that once printed daily grain and cotton prices. They sourced handwritten dealer logs, old ticker tape records, anything that captured how a market price moved on a specific day in the past. This was not glamorous work. It was obsessive, unglamorous archival labor, closer to what a historian does than what a trader does. But collecting old data was only half the problem. The other half was cleaning it. A price record from 1950 might contain a typo. A stock listed in 1962 might have split 3 times and been acquired twice before disappearing entirely. Dividends, corporate restructurings, currency redenominations. Each of these events creates a distortion in the raw historical record that, if left uncorrected, teaches the model the wrong lesson. Renaissance devoted serious resources to scrubbing every data point it collected, adjusting for every known distortion, and verifying records against multiple independent sources wherever possible. This is where the real competitive advantage lived, not in some brilliant formula, but in decades of painstakingly cleaned, verified, and organized market history that no competitor could simply buy. When rivals later tried to copy the Renaissance approach, they quickly discovered that the models were almost secondary. The true barrier was the library. Building a comparable data archive from scratch would take not months, but decades, and there was no shortcut available, regardless of how much money you threw at the problem. The moat was not intellectual property in the conventional sense. It was accumulated, verified, irreplaceable historical record, the kind of asset that only time and obsessive care can create. Part 3. The statistical engine at the heart of Medallion data alone, no matter how deep or well organized, cannot trade itself. Something has to read it, interpret it, and act on it with speed and consistency no human could match. That something, at the heart of the Medallion Fund, was a statistical framework most people have never heard of, the hidden Markov model. The name sounds intimidating, but the idea behind it is surprisingly intuitive. Imagine listening to someone speak through a wall. You cannot see their mouth, their expressions, or their notes. All you have is the muffled sound reaching your ears. Yet your brain, without consciously trying, pieces together what they are saying. You are inferring a hidden reality from observable clues. That is precisely what a hidden Markov model does, mathematically. Leonard Baum originally built this framework at the Institute for Defense Analyses to handle speech recognition, the problem of figuring out what word was spoken based on the acoustic signal received. When Robert Mercer and Peter Brown arrived at Renaissance, after years of applying Baum's work at IBM, they carried that toolkit with them. The insight that followed was genuinely striking. Markets, like spoken language, have hidden states. At any given moment, the market is operating under some underlying condition, a trending regime, a mean reverting regime, a high volatility state that you cannot directly observe. What you can observe are price movements, trading volumes, and other surface-level signals. The model learns to read those surface signals and make a probabilistic guess about which hidden state is currently active. What this gave Renaissance was not certainty. Nobody at the firm ever claimed they could predict markets reliably. What it gave them was a consistent, marginal, statistical tilt in their favor, something closer to 51% than 50% on any given trade. That sounds almost disappointingly modest, but Jim Simons understood something that most people miss entirely. Probability advantages do not have to be large to be extraordinarily powerful. They just have to be real, and they have to be applied at scale, repeatedly, across hundreds of instruments and thousands of trades with disciplined use of leverage. Think of a casino. The house edge in blackjack is roughly 0.5% under optimal conditions. Yet casinos generate billions annually from that fraction of a percent, simply because the game is played millions of times. Renaissance applied the same logic to global financial markets, but with a more sophisticated edge and a far larger playing field. The data library they had built gave the models enough history to learn from. The models themselves, grounded in speech recognition mathematics, gave the trades enough statistical justification to act on. These two things created a compounding engine that over decades produced returns so extraordinary that many professional investors initially assumed the numbers were fabricated. Part 4. A firm designed to be unknowable. But what good is a machine if someone can walk out the door with the blueprint? That question sat at the center of how Renaissance structured itself as an organization. The returns were extraordinary, but returns attract imitation. Simons understood that the moment any single person inside the firm believed they held enough of the picture to rebuild it elsewhere, the machine became vulnerable. So he built something unusual, not just a secretive company, but a company designed so that secrecy was woven into the daily experience of everyone inside it. Every employee signed a non-disclosure agreement that did not expire when they left. It followed them out. Lawyers stood ready to act on any breach. But the legal framework was only part of it. The more interesting layer was operational. Programmers worked on isolated modules, contributing pieces to a system whose full architecture they were never shown. A person building one component of the model had no visibility into what the neighboring component was doing or why. They could see their own corner of the room, not the room itself. Gregory Zuckerman's reporting makes clear that this was intentional design, not bureaucratic accident. By ensuring that no individual could mentally reconstruct the whole system, Simons removed the temptation to defect. You cannot replicate what you do not fully understand. The models became, in a very real sense, collectively owned, but individually inaccessible. Like knowing a song exists, but never hearing the full melody. Think of it this way. Imagine a factory where each worker assembles only one bolt, never seeing the finished product. Even if that worker leaves, they cannot build the machine. Renaissance operated on that same principle, but applied to some of the most sophisticated financial algorithms ever constructed. The secrecy was not paranoia, it was architecture, and it protected the edge that made everything else possible. Chapter 3: Medallion and the Mathematics of Wealth, Part 1: From Futures to Equities, the expansion that broke all records. Futures markets were where Medallion learned to walk. Commodities like oil, wheat, and gold, along with currency pairs, gave Renaissance something invaluable: clean, consistent, historical data stretching back decades. These markets moved fast, reset quickly, and forgave modeling errors because there were always new trades to make. The fund built its early edge here, and for a while, that was enough. But by the mid-1990s, Simons and his team were staring at a much bigger room next door: the equity markets. Stocks represented thousands of tradable instruments, compared to the relatively limited universe of futures contracts. The historical data was enormous. The opportunity, at least on paper, looked extraordinary. The problem was that equities are genuinely messy. A company's stock price doesn't just respond to supply and demand patterns. It reacts to earnings announcements, CEO resignations, lawsuits, product recalls, and 100 other corporate events that don't exist in commodity markets. There were also far more competitors trading equities than futures, which meant any statistical edge would be thinner and harder to hold. The signals were noisier. The models had to work harder just to find something real. What happened next is the part that still surprises people who study quantitative finance. When Renaissance adapted its models to equities, performance didn't just hold steady, it accelerated. The sheer volume of tradable instruments meant the fund could find more patterns across more situations simultaneously. The edge didn't shrink under competition. It multiplied because the data set was so much richer than anything futures markets could offer. Think of it like switching from fishing in a small pond to fishing in an ocean. Yes, the ocean has more competition and more variables, but it also has infinitely more fish. Medallion learned to fish the ocean better than anyone else, and the catch grew accordingly. This expansion is what transformed Medallion from a very good fund into something that has no real historical comparison. The returns stopped competing with other hedge funds and started existing in a category entirely their own. By moving into equities without abandoning its statistical discipline, Renaissance had essentially built a money machine that fed itself on market complexity rather than being threatened by it. The harder the market became, the more data it produced, and the more data the models had to work with. Part 2, 5 and 44, the world's most aggressive compensation model. The standard hedge fund fee structure is so familiar that most investors stopped questioning it decades ago. 2% of assets, 20% of profits. That was the deal. Everywhere, always. Then there was Medallion. Renaissance charged 5% on assets and took 44% of every dollar gained. Read that again. nearly half of all profits, before investors saw a cent. By any conventional measure, this should have ended the conversation before it started. No rational allocator, no pension committee, no endowment board would sign those terms. And that is precisely the point. The fee structure is not just an interesting number. It is a confession. It tells you more clearly than any marketing document ever could that the returns on the other side of those fees were so large that investors still walked away better off than they would have been anywhere else on earth. You only accept terms that aggressive when you have no real alternative, when the net of fee result still beats every competitor so badly that complaining about the cost feels absurd. What makes this even more unusual is who the investors actually were. Medallion was closed to outside capital. The fund's investors were Renaissance employees and Simons himself. So the fees were, in a practical sense, circular. The firm was charging itself, enriching the same people who generated the returns in the first place. The money went around a closed loop, and everyone inside that loop got wealthier with each rotation. This matters beyond the curiosity of the number. Most hedge fund managers get rich from asset gathering. A fund charging 2% on $10 billion earns $200 million annually, regardless of whether it makes or loses money for clients. That fee structure quietly rewards size over skill. Medallion's structure did the opposite. With employees as the only investors, there was no asset base to grow passively, no external capital to coast on. Every dollar earned came from performance. The incentive was pure, and the results reflected it. Part 3. When the models held while everything else collapsed. Most people assume that financial crises destroy everyone equally. The 2008 collapse proved that assumption wrong in the most dramatic way possible. While Lehman Brothers was filing for bankruptcy, while seasoned fund managers were watching decades of accumulated returns evaporate in weeks, and while governments were wiring emergency funds to banks to prevent total systemic collapse, Medallion's computers kept working quietly in the background and delivered roughly 80% returns for the year. Not 80% relative to some benchmark. 80% actual gains in the single worst year for global finance since the Great Depression. The reason this happened is simpler than most people expect. Almost every major fund that collapsed in 2008 was built on some form of reasoning about how the world works. Their models assume that banks behave rationally, that institutional investors act predictably, that credit markets follow logical patterns. When panic set in, all of those assumptions broke at once, and the models became useless at exactly the moment they were needed most. Medallion's models carried none of those assumptions. They were never looking at why prices moved. They were looking at how prices moved, the raw statistical patterns buried in decades of historical data. When panic pushed asset prices into extreme, historically unusual territory, those patterns did not disappear. They became sharper, more tradable. The chaos that made everything else unreadable was, to Medallion's system, simply a louder version of the same signal it had always been processing. Think of it this way. Most traders were trying to navigate a dark room by reasoning about where the furniture should logically be. Medallion had memorized every inch of the floor from 10,000 previous trips through the room. When the lights went out, everyone else froze. Medallion kept walking. This is what separates statistical pattern recognition from theory-based investing at the most fundamental level. Theories depend on conditions remaining stable enough for logic to apply. Patterns require only that human behavior remain recognizably human, which, even in a crisis. Part 4. Why Renaissance kept the fund small by choice. Most people assume that if something is working, you scale it up. Simons did the opposite, and that decision is what kept Medallion untouchable. When a fund makes money, the natural instinct is to raise more capital, attract more investors, and let the returns compound across a larger base. It feels logical. More money in, more money out. But Simons understood something most fund managers either miss or choose to ignore. Size is not neutral. It changes the game entirely. At some point, a fund becomes so large that it stops trading the market and starts moving it. Medallion's edge lived in short-duration, high-frequency trades, tiny price inefficiencies that existed for seconds or minutes before disappearing. The fund had to move quickly and quietly to capture them. Think of it like fishing in a small pond with a very specific lure. It works beautifully when you're casting a line. But if you drag a net through that same pond, you don't catch more fish. You destroy the ecosystem and catch nothing. Simons understood that Medallion was the line, not the net. This is what economists call market impact. When a fund is large enough, its own buying drives prices up before it finishes buying, and its own selling drives prices down before it finishes selling. The fund essentially trades against itself. The anomaly it was built to exploit disappears the moment it applies enough capital to matter at scale. So Simons did something almost unheard of in finance. He capped the fund and returned money to investors. He handed back capital rather than deploy it into diminishing returns. The discipline required to do that, to say no to growth when growth is profitable, is genuinely rare. The proof came from Renaissance's own public funds. When the firm launched REF and RETA to serve outside institutional investors, they used similar mathematical signals but deployed them at a far larger scale. The results were ordinary. Not catastrophic, but nothing like Medallion. Zuckerman is careful here. This isn't speculation. It's a controlled comparison from the same firm, the same researchers, and largely the same data. The only meaningful variable was size, and size broke the edge. What this tells you is that Medallion's returns were never just about having the right models. They were about deploying those models within a very precise set of constraints. The strategy and the structure were inseparable. You could not take the engine out of the car and expect it to run the same way sitting on a different chassis. Simons built something that only worked at a specific size, in a specific way, and he had the intellectual honesty and the confidence to protect that rather than chase the illusion of unlimited scalability. Chapter 4: Power, Legacy, and the Price of Genius. Part 1. When the Black Box Financed Democracy's Disruption. Robert Mercer's story is one of the strangest and most unsettling in modern American life. Here was a man who spent his days feeding market data into machines, letting pure statistics guide billion-dollar decisions, and rejecting every form of conventional wisdom. That same mindset, it turns out, translated with alarming ease into political warfare. Mercer rose through Renaissance as one of its most technically gifted minds. His early work on natural language processing, teaching machines to understand human speech, was genuinely groundbreaking. Inside Medallion, he helped build the equity models that turbocharged the fund's returns through the 1990s and 2000s. He was, by every account, exactly the kind of contrarian, data-obsessed thinker that Renaissance ran on. The problem is that those same qualities, when pointed at democracy rather than markets, produce something far more troubling. Zuckerman documents how Mercer funneled tens of millions of dollars into Steve Bannon's political projects, into Breitbart News, into Cambridge Analytica, and ultimately into Donald Trump's 2016 presidential campaign. Cambridge Analytica alone became a symbol of how data, the same weapon Renaissance used to beat Wall Street, could be turned on voters with surgical precision. Think of it this way: if you can train an algorithm to spot hidden patterns in stock prices, you can probably train one to spot hidden vulnerabilities in human opinion. What makes this section of the book so genuinely uncomfortable is the mirror it holds up. The intellectual DNA of Renaissance: distrust institutions, ignore consensus, trust only the numbers, didn't change when it left the office. It just found a new target. Simons, a lifelong liberal donor who gave heavily to democratic causes and scientific institutions, found himself co-leading a firm that had effectively helped elect a president he considered a catastrophe. He and Mercer eventually reached a breaking point, with Mercer stepping back from the co-CEO role in 2017 after public pressure mounted. What Zuckerman captures here isn't just a political disagreement between two rich men. It's something deeper. A warning about what happens when a culture built entirely around radical autonomy and contempt for received wisdom produces people who genuinely believe they see truths Others are too timid or too conventional to acknowledge. That confidence works brilliantly in a closed system where markets provide immediate, measurable feedback. In a democracy where the consequences of being wrong arrive slowly and fall on millions of ordinary people, it works very differently. The black box that minted money in silence had, in Mercer's hands, become something that reshaped the political world in ways no algorithm could have predicted or corrected. Part 2. The Simons Foundation. Science as a Second Career. Simons walking away from a billion-dollar machine to fund pure mathematics tells you everything about what actually drove him. Most people who accumulate serious wealth build a foundation as an afterthought, a tax structure with a press release attached. Simons did something genuinely different. The Simons Foundation, which he built alongside his wife Marilyn, has directed over $6 billion into fundamental science, not the kind that produces a drug or an app in 5 years, but the kind that sits quietly in a journal for decades before it changes everything. Basic mathematics, theoretical physics, the biology of the cell. These are fields where the payoff horizon is generational, and where most donors simply refuse to go. The autism research strand of the foundation carries a different weight entirely. 2 of Simons's children died, Paul in a cycling accident, Nick by drowning, and a 3rd child was diagnosed with autism. Suffery, the foundation's autism science initiative, became one of the most serious and well-funded efforts in the world to understand the genetic and neurological roots of the condition. This was not charity as image management. It was grief converted into rigorous scientific method. Math for America, arguably his most personal project, recruits gifted graduates into public school mathematics teaching by paying them properly and treating the profession with the respect it rarely receives. The underlying logic is simple. If you believe quantitative thinking is the most powerful tool human beings have ever developed, then the best long-term investment you can make is ensuring more people actually learn it well, starting young. What Zuckerman makes clear is that none of this represents a break from Simons's previous life. It is the same operating system running on a different problem. At Renaissance, the conviction was that patient, disciplined, data-driven reasoning could find signals in markets that human intuition perpetually missed. At the Simons Foundation, the conviction is that the same patient, disciplined approach can move science forward in fields where short funding cycles and institutional caution have created decades of stagnation. The method did not change, only the domain did. This is actually a rare and underappreciated form of consistency. Most people compartmentalize, hard-nosed in business, sentimental in giving. Simons never compartmentalized. He treated philanthropy as an intellectual project with a hypothesis, a methodology, and a long time horizon. Whether that approach will ultimately prove as successful in science as it was in markets, only the next 50 years will tell. Part 3. How Simons changed the game for everyone else. What Simons proved was not just that he could win. He proved that winning was possible in a way nobody had publicly demonstrated before. That distinction matters more than it sounds. Before Medallion's track record became impossible to ignore, quantitative investing was a fringe idea. Most serious money was managed by people who read annual reports, visited companies, and trusted their judgment. The idea that a team of physicists and mathematicians sitting in Long Island could consistently outperform them by running statistical models felt eccentric at best, delusional at worst. Medallion did not just outperform. It averaged roughly 66% gross returns annually for decades. Once that number circulated through the financial world, the intellectual case for human intuition-based investing simply collapsed. The firms that followed, 2 Sigma, D.E. Shaw, AQR Capital, Citadel, did not copy Renaissance. Nobody could. The method stayed locked inside East Setauket behind non-disclosure agreements so airtight that former employees reportedly could not describe their own work without legal risk. What these firms copied was the belief. They accepted the premise that markets are essentially a data problem and restructured their entire operations around it. That meant hiring fewer MBA graduates and more PhD statisticians, buying satellite imagery to count cars in retail parking lots before earnings reports, and building server infrastructure physically close to stock exchanges to shave milliseconds off trade execution. The game changed because one player proved the game was winnable. Here is the cruel irony Zuckerman captures so well. The moment Simons demonstrated that statistical patterns in markets could be systematically exploited, he effectively started a timer on those patterns. Every sophisticated firm chasing the same anomalies gradually arbitrages them away. The edge shrinks. The arms race intensifies. More data, faster machines, sharper algorithms, all chasing a pool of exploitable inefficiencies that keeps getting smaller precisely because so many brilliant people are now hunting it. Simons created his own competition, and that competition, in aggregate, made markets structurally harder to beat than they were before he started. The average investor probably never thinks about any of this, but it touches them anyway. The tighter spreads they get when they buy a stock, the faster prices adjust to new information, the reduced opportunity for obvious mispricings. These are partially downstream effects of the quantitative revolution Medallion demonstrated was worth pursuing. Simons made markets more efficient, partly by proving, spectacularly, that they were not efficient enough. Part 4. What did Simons actually discover? And does anyone know? And yet, after everything, the decades of returns, the recruitment of the world's sharpest minds, the billions made with mathematical precision, nobody can actually tell you what Medallion found. Not Zuckerman, despite years of reporting. Not regulators, despite having every legal incentive to understand it. Not the sophisticated competitors who built entire firms trying to think like Renaissance. And in a detail that should give everyone pause, probably not even most of the people who work there. This is the part of the story that sits with you longest. Renaissance is structured so that employees work on isolated pieces of the system. A researcher might spend years refining one small component of the model without ever seeing how it connects to the whole. It is less like a company and more like a machine whose builders each made one gear without seeing the finished clock. This was deliberate. It is also, depending on how you look at it, either brilliant risk management or the most consequential secret in financial history. What Simons' team appears to have found, and this is the honest limit of what anyone outside can say, is that markets contain patterns. Not obvious ones, not the kind a clever analyst spots over coffee. Something deeper, more structural, buried in the noise of price movements across decades and asset classes. Patterns that repeat just often enough to be real, and just subtly enough to stay hidden from everyone who is not specifically looking for them with the right mathematical tools. Here is what makes this genuinely unsettling. If those patterns are real and consistent, and Medallion's 4-decade track record suggests they are, then markets are not as fair or as random as most investors are told to believe. One group found a structural truth about how prices move, and for 40 years, they quietly collected the difference between what the market offered and what those patterns predicted. Nobody stopped them, nobody else cracked it. And when Zuckerman asks whether this made markets better or simply made Simons richer, he honestly does not answer, because the honest answer is that nobody knows. That ambiguity is the book's most important contribution. It doesn't leave you with a formula or a lesson you can apply on Monday morning. It leaves you with a harder question. If the most successful financial operation in history rests on discoveries that are simultaneously real, proven, and permanently private, what does that say about the nature of markets and about who they ultimately serve?